So today let's go ahead and talk about hype investing. My name is Dennis, and this is Financial Freedom with Dennis. So I guess the best example about speculation and hype investing has to go all the way back to the dot-com bubble of around 2000. Look a couple of years before that, a couple of years after that, and you'll see a massive run up with the stock prices and then subsequently a massive drop off in the stock prices. To summarize what happened, you can find documentaries on exactly what happened, very long videos. But to summarize, stock prices got bid up way above their intrinsic values. Some companies which have no business models whatsoever, all they had were the words .com in their name, just being very simplistic when I explain it like that. Pretty much these are internet companies, and we know the internet did revolutionize the world. Hit that like button, the internet's awesome. But the issue is, just because something revolutionizes the world does not mean that if you invest in any stock, it's going to be successful. And oftentimes you can go ahead and look at some of these internet stocks from back in the day, and you'll see that even right now, some of these stocks have still not reached the peak that they reached over 20 years ago. So just because something is probably going to be the future or potentially the future does not necessarily mean that you should just buy that stock. A couple of examples such as the plant-based food movement, stocks such as Beyond Meat. If you look at the financial statements in those companies, probably not the best investments. And the same goes for artificial intelligence. My investing philosophy keeps me away from such companies. Let me explain. The best analogy, since I apparently like to use analogies, is imagine you go to a store, right? And the store is selling a coat. Now, let's say it's winter time. In other words, let's say that it's a very popular time to buy a coat, right? It's a very popular time. Everybody wants to buy a coat. And you go to that store and everybody is lined up from the front all the way to the back of the store. They're all lined up and they want to buy a $300 coat, And everybody wants to buy it because everyone's saying, oh, look, it's 15% off. It's on discount. It's a great price to buy that coat. So everybody goes and buys it. But not me. Fast forward 6 months down the road and the sun's out. Guess what? I'm in that store and I can see that same exact coat, but this time in the back of the store in a clearance rack. And this time it's only for $120. And those same people that said that the coat was on discount for $300, they're nowhere to be seen. Not a single person is in line ready to buy that coat, but I'm there to buy it. That is my investment philosophy. And it's not just the philosophy shared by myself, it's also shared by many of the all-time greats. Peter Lynch famously said he likes to buy companies that have very low involvement with institutional investors. In other words, companies that have not been discovered by Wall Street yet. So these are companies that are cheaper. And once Wall Street discovers it, they'll bid the stock price up. And that's how Peter Lynch is able to sell the stock for higher and make money. And he goes on and says other stocks that are more unpopular. Let's say, for instance, Waste Management. That was a company way back in the day when he was talking about it. Nowadays, it's a very popular stock, so you might not find the value that Peter Lynch found in it. But the idea still goes, right? He talks about funeral stocks, companies that are burying and, they sell coffins, they bury people, those type of companies that are maybe not as flashy as companies such as Tesla. And those are the companies that if there's not 100 analysts looking at them, perhaps you'll find value. And that's the essence of value investing. But I don't want to say that just because a stock is popular, there's no value. We can go ahead and look at my investment in Meta. Right when everybody was running out the door and when Jim Cramer was crying saying that the stock was uninvestable, there were a select handful of brave investors that were walking in the store while everybody else was running out, ready to buy the coat, right? Ready to buy that $120 coat, or in this case, Meta below the price of like $90, right? We bought that stock heavy while everybody else was selling, while everybody else was panicking. And the reason why we bought this stock is not because it was an unpopular stock at the time, well, even though it was. The reason why is because it was a misunderstood stock. Everybody misunderstood Meta. And if you go and look in the balance sheet, if you actually go and read what they wrote in their investor presentation, you'll see that Meta was not planning on spending 100% of their cash in the metaverse. Rather, they were spending 80%, approximately 80% on things such as their core business, their advertising technology. And in that sense, while everybody else was running out of the store afraid and selling the stock, I was extremely bullish because I saw an opportunity because the stock was mispriced. So what I'm doing is the opposite of hype investing. And as you know, the result of that is Meta stock has gone way up. I'm way up in that position, and right now it's about 20% of my portfolio. I didn't buy Meta intending on it to be 20% of the portfolio per se, but I guess this is where we're at. This video is sponsored by me. Have you ever watched Gordon Ramsay in Kitchen Nightmares? You know, that one show where he goes to a failing restaurant that's almost bankrupt, and he screams at everybody, and he eventually turns the restaurant around, or he tries to? Well, I'm Gordon Ramsay, and you're the failing restaurants. I'm starting a new series called Financial Doctor, where I look at your personal finances, whether you're in car debt, whether you have credit card debt, other loans, or you're in a bad financial situation. Go ahead and email me at dennisfinancialdoctor@gmail.com. So over the last few years, I've witnessed the exact same phenomena happening over and over and over again, with retail investors piling in at the wrong times and Wall Street selling and leaving the bag to retail. Such examples include the vaccine stocks such as Moderna, Pfizer, and those companies which were bid up to ridiculous valuations at some point. The electric vehicle craze was another thing. Even though electric vehicles are probably going to be the future, it does not necessarily mean they should be investing in a company that has absolutely they have no capability to produce cars, or they don't even produce many. They have no profits yet, and in general, when you're investing in unprofitable companies that are very far from profitability, you're probably going to lose money. Weed stocks when Joe Biden was elected president, and even most recently right now, tech stocks, where the moment they say the word, oh, we're gonna lay off X amount of workers, the moment that happens, the stock gets bid up ridiculous prices. But if you look at those stocks, 1 week before that, the stock was way down and nobody was even wanting to buy it. So stop chasing the hype, buy the stocks when they're actually undervalued, and don't be buying stocks just because everybody else is doing so. The most recent example, of course, now is the artificial intelligence stocks, right? And I guess the best way to exemplify that is if you look at NVIDIA's most recent earnings call. They used the word AI like 1,000 times, and that stock just went pumping. I think the stock is up like 15% today. It's ridiculous. It just goes to show that if they use the right words, people will buy the stock up. But remember, there's a difference between long-term investing and trading. And if you're not trading the stock, you probably should not be buying these stocks at such heightened valuations, or you'll lose your money. The moral of the story, stop following the crowd, make your own path, and you'll probably become a better investor.